Hi, we're Theta Consulting. Let me present to you my team. We have Gabriel Boivin, Léa Capobianco, and myself, Pierre-Yves Gendron.
So for today's presentation, we identified three main topics. First, we're going to assess the current situation quantitatively. Then we'll identify our strategic asset location for our portfolio, and finally make some other recommendations for the case.
The situation is the following. So we have $8 billion shortfall, and we are 80% fund. And the municipalities are paying 12% of their annual revenue as to fund that shortfall. So that's too high. And we'll have to increase the pension fund's revenue to help them. The first question that we asked ourselves was, what kind of return do we need? So right now, we are getting 7%. But is 8% enough, 9% enough, 10% enough? So we made a model, right here, that gives us the special contributions in comparison with the initial allocation. Like I said, it's 7% return and 12% standard deviation. And we can see that just increasing a little bit return lowers the special contributions by a lot, while the standard deviation helps us, but to a much lesser degree. And we won't use this model to create a mean variance portfolio, but rather as a decision aid tool. So it's a simulated model, and we have a few hypotheses. The most important one is the last one, so there's no new participants. And this is a very conservative assumption, because every new participant would bring money on the short term and liabilities on the long term, which we can handle.
Thank you. So now that we know approximately what type of risk-return mix we need, we have to figure out which asset classes will allow us to generate higher return as well as minimize tail risk. So our strategy is to take advantage of the Van Peers fund structure to generate alpha. So since we are a pension fund, our returns are non-taxable. We can invest over a long-term horizon, and we can also invest as an institutional investor. So to take advantage of that, we can invest in a high dividend equity portfolio. We can also invest in more illiquid assets to capture the illiquidity premium. We can also invest in more complex or more restricted asset classes, such as venture capital, private equity, convertible bonds, to capture the market segmentation premium, and we'll rely on those premiums to generate higher returns. So we've selected all of the following asset classes. The ones in red are the ones we've added from the initial asset allocation. So we've added convertible bonds to potentially generate higher returns from the equity kicker in the bond. We've also selected real estate and infrastructure to diversify the portfolio, but also to get steady cash inflows from those asset classes. We've selected farmland and timberland because those asset classes have low correlation with the overall market, so they react quite well during a systemic market event. Timberland also allows us to further diversify the portfolio with some commodity. We also invest in venture capital, mainly to create synergies between our venture capital firms and our private equity firms. And we also have real options with some of these asset classes, such as timberland, venture capital, and private equity. So here's a table of why we chose each asset class. We won't have time to go over the details of each one, but if you have any questions at the end, we'll be glad to answer. And we also included in the report which instruments we'd use for each investments. We also selected the asset classes for risk management purposes. So we invest a lot in the real assets and alternative investments to decrease tail risk and decrease inflation risk. We also invest in treasury inflation-protected securities to have less exposure to inflation risk. We also invest in low-duration bonds to have little exposure to interest rate variation. We also invest in investments that are denominated in the local currency to avoid exchange risk. Otherwise, we would just hedge it with a future contract or so on. We also invest a lot in the local economy with private equity and venture capital to diversify the local economy because it will help the municipalities. But one thing that's really important to mention is we want to avoid the declining local economies to avoid a positive correlation between our fund performance and the financial situation of the cities. As I said, we have more liquidity risk because we invest in liquid assets. The flip side of that is that we need at least some liquid assets for the short-term needs of the fund.
So to structure our asset allocation, we based our estimated returns on our benchmarks, and we made some adjustments. Because, for example, we thought that 2.3% return for venture capital was too low, so we adjusted it. One important thing to mention is that we didn't compute the correlation matrix because we thought it wouldn't be useful over time. To think that the correlations would be the same in 10 or 20 years is not realistic. So we actually made an assumption of a worst case scenario that all of our asset classes are perfectly correlated, which they're not. So we could achieve even better than what we estimated. So that's the asset allocation we came up with mainly 25% in bonds for the short-term liquidity and 25% in real assets for the long-term return. That's the asset allocation that gives us the most diversification and allow us to attain the risk-return mix we aimed with our quantitative model.
So here we have a summary of the changes between the initial Van Peers allocation and the proposed changes. So we get 1.6% more return, and we reduce the standard deviation by 2.4%, and we cut the special contributions in half. So I say we cut it in half, but it's the expect value. So if we get a little bit less return, we still reduce by 33% the special contributions, which we think is really significant. Remember that this model is conservative, so we'll probably do better than that. And finally, you can see that the model is sensitive to geometric return, and that's why we don't just use a mean variance portfolio, because it would be very hard to estimate properly. And our strategy also evolves through time. So as we get 90% fund, we apply a collar on equity. It's a self-fund collar, and the more fund that we are, the stricter the collar becomes. That's for equity, but we can also, there is a portfolio by selling private equity and real estate to invest more in bonds.
So for the quantitative strategy to work, we still have some qualitative recommendation for the state and for the funds operation that we mentioned in the report. For example, on a state level, we recommend to lower the average age of public employees, to adjust the retirement age over time, as well as to index it to the life expectancy for the longevity for the aging of the longevity risk. Sorry. Then again, we recommend, for example, to offer the option of progressive retirements, but we are very aware that these recommendations would actually need strong unions negotiations to implement. On the funds operation level, the most important one is that we want to install performance-based compensations for the funds managers, as well to evaluate their performance comparatively to our benchmarks as an incentive for good performance. For the investment, we recommend to take in consideration the ESG concerns for a more independent governance, as well as for investment matters such as fiscal evasion, for more ethical investments in our portfolio. So that's why we think our strategy can work. It's because it's realistic. We consider a long-term horizon for investments, and our asset classes are reliable. They have fundamental values, they have historical data, so our estimates are reliable, and our risk-return mix is very attainable. And for all that, we think our strategy is pretty realistic. And the highlights of our strategy are the following that we just presented. First of all, major decrease in municipalities' contribution, as well as a comprehensive risk management measures and better incentive for the funds management. Our strategy is based on very simple investment principle, and that's what makes it very realistic and could make it work actually. So we thank you very much for listening, and it's time for the questions.